For more about what we went through this year, and of course we're going to look ahead to next year, John Quelch joins us, professor at the University of Miami's Herbert School of Business. Good to see you again, Professor. What a year it's been. In our last report, we talked about the revised GDP figures, and I can't help but think bad news is now good news. My, how it's changed so quickly.
Certainly there was a lot of doomsayers during the last calendar year who've been proven wrong. The consumer has held up very strong in its spending. The labor market is still strong. And indeed, as your lead reported, stocks have been doing extremely well, up the S&P about 25+% this year. And the economy has grown much more than was predicted or expected. I think that's largely a function of very substantial government expenditures from the Biden administration. It's also a function of consumers taking on credit card debt and not compromising their lifestyle in the face of economic headwinds.
Just a few months ago, we were talking about how higher rates would impact consumers, higher rates would impact car manufacturers, it would ultimately impact company formations, which ultimately leads to potential less job creation or worse, job cuts. And in a matter of just a few weeks, poof, all those worries have disappeared because we think that the Fed could cut rates next year. But here's the thing. You are a history person. You know your history very well. The Fed doesn't just cut rates just because it feels like it. There has to be a reason. What possible reason would they cut rates next year?
It's an election year. And although the Fed is supposedly insulated from political influence, that's an impossible thing for us to expect of them. There will be rate cuts for sure, whether or not it's 2 or 3 or 4, whether or not they begin in the second quarter or the third quarter, that's a matter for debate. But obviously the speculative bubble on Wall Street is assuming that they are going to happen. There is clearly a slowdown that's likely in the fourth quarter of this year from the 4+% growth rate that you mentioned. The Atlanta Fed is forecasting a 2.7% growth rate in the fourth quarter that we're just finishing now. And the question is whether or not it's going to be a beautiful soft landing in the first half, right, or whether or not there's going to be a mild recession.
I mean, nowhere in the Fed mandate does it say it has to have a certain growth rate. The issue is price stability equaling to the inflation concerns, which we had a lot of inflation concerns. If the economy were to remain strong going into, say, next year, wouldn't inflation rise up again, and that would ultimately be the concern of why they would not cut rates?
Absolutely. So just to take one small example, but it could be quite significant, is the tension in the Red Sea and the rapid increase in shipping container prices in the last 4 weeks. Supply chains, again, likely to be disrupted as ships are diverted around the tip of Africa. And so something like that impacts immediately, or at least over a 3-month period, prices at retail. And the prices at retail are what the politicians in Washington just cannot afford to take their eye off, because those prices at the pump and in the grocery store are going to drive a lot of votes on election day in November of next year. The government does not want to prematurely see rates cut and inflation fueled again.
So, John, with you saying that, or am I translating this correctly, that perhaps a lot of the bulls out there are too optimistic about 2024?
I would say that the market at the moment, the stock market, is definitely over-optimistic.
So if they're too optimistic, and we're not going to get the Fed cuts. I think there were I've heard 3 to 4 Fed cuts next year. What is your expectation on what we should invest as investors for the economy, that is, in 2024? And I know you said it's an election year, so you should feel good about that.
Certainly, the importance of maintaining cash positions has been, I think, diminished. At the same time, if the rates are not coming down, of course, your money market rates that only a couple of years ago were 1 or 2% at the most are now going to sustain themselves at about 5% or 4 to 5%. And you have to obviously offset that against the risk of putting that money into a seemingly overheated equity market.